Equity curve trading is an interesting concept that has been gaining popularity recently. I will explain what it is, show some examples of it in action, and discuss why it may or may not work. With equity curve trading, you use the shape of your equity curve to determine whether to pause or resume trading a certain strategy or portfolio of strategies. If your equity curve has been faring well, you leave the strategy untouched. But if it goes into drawdown or stagnates, you may consider pausing the strategy. Here's an example in Quant Analyzer's equity control module. The light blue line is the original equity curve as shown previously. For some objectivity, a moving average of the equity curve is most commonly used to establish a performance benchmark. Every point on the curve is a new trade, and the equity level at that point is the account balance at the trade open. If the original equity curve falls below the 50-period moving average, indicated by the red line, trading is paused. The thick red line at the bottom shows when trading has been paused. The dark blue line is the modified equity curve, which takes these pauses into account. Trading is resumed when the equity curve crosses above the moving average. In general, if your strategy has extended periods of underperformance like the one shown here, equity curve trading will likely preserve your capital. On the flip side, if your strategy performs well, it's unlikely to be deactivated, and equity curve trading will make little difference. In this example, since there are clear periods of strong and weak performance, results actually improve with equity curve trading. Unfortunately, trading is rarely this straightforward. Most of the time, you will probably have a live equity curve closer to this. This time, equity curve trading made performance worse. Let's zoom in on this area to find out why. At this point, after a series of bad trades, the original curve dipped below the 50-period moving average, and trading was paused. Unfortunately, the very next trade was a profitable one that pulled the curve back above the moving average, which you would have missed with a trading pause. This discrepancy causes a divergence between the original and modified equity curves, which is slightly reduced when the strategy suffers another losing streak here. But yet again, the original strategy manages to recover with numerous winning trades, which the modified curve does not catch, widening the disparity again. In this way, with equity curve trading, you will catch all the losing trades that cause strategy deactivation, but catch none of the winning trades that cause reactivation. The moving average control curve, or whatever method you use, is usually always one step behind. Could this be a problem with the choice of moving average period? I redid the simulation with periods from 20 to 100 in steps of 20. In general, longer look-back periods seem to work better, but there's little point having periods over 100, since pauses are unlikely to ever be triggered. With longer lookbacks, the obvious drawback is that you stand to lose more capital before the strategy gets deactivated, but you also get fewer whipsaws and fewer missed profitable trades. Of course, a moving average crossover isn't the only way to do equity curve trading. Quant Analyzer offers other such methods using the Bollinger Bands and the Ichimoku. You can also write your own code in Java. For my own testing, I believe equity curve trading rarely works unless the strategy goes into a deep drawdown and never recovers, or eventually experiences a smooth recovery. For more conventional curves like these, any capital preservation will probably not compensate for the loss of profitable trades. In addition, programming the logic to deactivate or reactivate a strategy is not a trivial task, and if you trade manually, you'll be really busy when the strategy goes into consolidation, which is practically guaranteed at some point. If you manage to use equity curve trading successfully, why not share it in the comments? To learn about Dr. Elder's 6% rule for risk management, check the video at the top. If you're considering getting a Forex VPS, check the video at the bottom.